Well, hello there and welcome in to the Gen Wealth Radio Hour, and the What's Happening segment kicks it all off for you. My name is Scott Inman, financial advisor at Gen Wealth, and along with me out of the Conway office, driving all the way down to the West Little Rock office for today's program is Teresa Arago. How are you?
Good. It's good to be here. I'm excited.
Yeah, we've got some good topics today, so if you haven't been with us for a while and haven't heard the What's Happening segment, this first few minutes of our radio hour is about kind of diving into what's we see out there, either on social media or online, potentially even from a journalism standpoint, what's being broadcast in the media with regard to financial topics. And it could be anything. Our marketing staff drives this for us, and they do a great job. But recently I've been trying to add and contribute a little bit, and I actually have been following a guy named John Stossel. Now, many of you may know who he is. I asked my wife this, who's just a tad behind me in age, so same generation. And we remember him from his 2020 days.
Yes.
He was a reporter. And he, just to kind of give you a little background before we dive in, he was kind of a consumer reporter or, a guy that was on the side of the little guy and trying to right wrongs. That was kind of his general style. And he writes a book later in life that says that when he was attacking big business, that he was extremely popular at 2020. But when he started showing and exposing government waste, he became less popular. And he's very libertarian in thought. So I do that to set up who this guy is. So what we're going to show you today, I mean, I love looking at him because he gives you another point of view. I'm not going to say that what he talks about here today is gospel, but it is definitely worth thinking about because it falls into the category of what we always say here. It's never as good or as bad as it may seem.
Yes.
And what we see all through social media is the younger generation talking about high home prices, the inability of affording a home. Times are tough. They can't make ends meet. And I'm not going to discount that in certain cases that is absolutely true. But we're going to offer a different take today. The title of this post, it's 5 minutes long, so we can only give you a little bit of it. It's called The Myth of the Good Old Days. Take a listen.
This meme gets millions of views. Once upon a time, meaning when I was a kid, a family could own a home, a car, and send their kids to college, all on one income. This meme is all over the internet. People believe it.
And that's really a fantasy?
Economist Norbert Michel. It's not true?
No, it seems really great to think that everything was so awesome back then, but it wasn't. Materially, we are so much better off now than we were in the 60s and 70s.
So think about that. Materially, we are so much better off now than we were back then. Now, this video dives into that in more detail, but basically the concept here is, yes, home affordability may be difficult, but when you relate that to the good old days back in the 50s and 60s and the narrative that everything was easier back then, it's just not true.
No, and I think one thing I liked about this, if you get the chance to go watch it, is he gives two different opinions. He doesn't just say, oh, it's not as good as it seemed, but he also has someone else on there that has a different opinion, so it's good to hear both sides of it. But when I think about when my parents were young, when I was born in 79, so I'm just a little behind this era, we didn't grow up eating out. We didn't grow up having a lot of things. You know, when my brother and I wanted a gaming system, we had to strip copper to be able to earn that thing. So I do believe that when he talks about the differences in our just material situation, my kids have wanted for almost nothing. Now, we're not frivolous all the time, but we do. They've gone on vacations. They've gone to Disney multiple times. My parents, that would have never been reasonable to do with their budget because they just were much more, I think, intentional with where their dollars went. And so, you know, our current young people, they value traveling. They value having experiences, and those are just not free. Right. So I feel like it's a little misleading to say, oh, we can't do these things. Well, many people could. You might need to change your location. You may be living in a very high cost, low pay area. But you also may need to adjust your priorities. I think we make more, but we spend more is maybe what I'm getting at.
Yeah, and the challenge is, I love these. There's a little bit of data that he drops in here from the Census Bureau. In 1950, 55% of Americans owned a home, and in 2025, that number was 65%. So the idea that fewer people are owning homes is just not true. Now, it doesn't break that down demographically. That was my question: is that 65% mostly the baby boomer generation, right? Because there are so many people living longer and owning those homes for a longer period of time. So that is true, but I do think that's a great perspective, though, on home ownership.
And I think culturally, our younger generation are more likely to change jobs multiple times. So the idea of setting down roots for a lot of young people doesn't make sense initially. So I have a lot of younger clients who choose to rent because they want to have the flexibility to move. So it could be that there's been a bit of a cultural shift going into that as well.
Yeah, and the median home size is pointed out in this video, that in 1963, it was 1,365 feet.
Oh, my.
In 2023, it was 2,286 feet.
Yes.
That is a product of...
Big difference.
Yeah, that's a product of the demand, right? Because home builders started building newer homes and people started buying those homes. And now we're at a point where maybe we need to go the other way. And I've seen that in certain locations here in Arkansas where starter homes are starting to look more like they did 20 and 30 years ago. My first home was 1,150 feet. And it was not anywhere near the 2,200 that the median home size is today.
Ours was tiny. Ours, I think, we joked that it was like a mobile home.
Yeah.
I grew up in one, so I'm allowed to say these things. But it was just like long. You walked in and there was a hallway, and that was it. And so there was 3 bedrooms, but the bedrooms were very small. Whereas my current house, it's not huge because we have a lot of kids, so we have to use our space wisely. But I have 2,100 square feet, and it still feels cramped because we're so large. I could not imagine being in a 1,300 square foot home now with my family.
But they did it. We rode in the back seat and up in the little window space underneath the window, lying down in a station wagon, right?
Well, and my bedroom in high school had a twin bed and a desk. That was it. That's all it could fit.
Yeah.
So it makes sense.
It's perspective. It's, and one more little note to drop here on you from the Bureau of Labor Statistics: as a percentage of our income spent on food, clothing, and housing. In 1950, that number was 60%, okay? So the average family spent 60% of their income on food, clothing, and housing. And in 2023, that number was less than 40%, okay?
Wow.
So, again, I think it's great for perspective. Again, not trying to discount the hardships that young people do have. I do understand that home prices have skyrocketed over the last 5 or 6 years. They haven't fully come back down to reasonable spots. Mortgage rates are higher. I get that too. They're higher than they were relative to when you were looking 5 years ago. Now, if you go back to the good old days, those mortgage rates were higher than they are now.
Yes.
So I think I think we all need to, honestly, I think we just need to calm down. And the rhetoric and the emotion that is on social media is not necessarily reality.
Yes.
It's never as good or as bad as it may seem.
Well, and they did talk about too college. One of the things said was,
Yes.
everybody sent their kids to college. No, they didn't. That was not the norm. In the 90s is when that really hit, where my generation
Was expected.
It was expected that
Yeah.
when you finish high school, you're going to college because you've got to have a college degree to do anything, which isn't true. It simply isn't. But back in the 50s and 60s, over half the workforce did not have college degrees. I feel like it was even higher when he was talking about it. I should have memorized that. But, like my dad was an electrician. That's not a degree program. There are a lot of options out there, and going to college isn't right for everybody.
Yeah, some great stuff there from John Stossel. I have a feeling we're going to see some more videos from him in the future on the What's Happening segment. Time to move on, though, to our next topic. This from a Market Watch article titled "Public Enemy Number One in Retirement and How to Prepare for It Ahead of Time." What do you think public enemy number one in retirement is? Well, it's one of the 3 big risks that we talk about every day, and probably every show we've ever done in the last
come up.
several years. It has come up. It is true. Inflation is the public enemy number one they are referring to, and we are in complete agreement with that. It is one of the 3 big risks, as we said, to your retirement. And I think I'd like to dive into a little bit about what it talks about, not just setting up what is public enemy number one, but what this article basically interviewed 10 financial advisors to get their take on what do you do about it. And they've got some good insight.
Yes. And what I love how they described it, because I think it's honest. It's a silent killer. It creeps up on you and you're not even aware of it. Now, I think in recent years, we've been more aware than normal because it had shot up pretty good there after COVID. But it is sneaky, because what happens is things just become a little bit more expensive, and then eventually the belt has to tighten just to take care of basic needs if you haven't planned for it. And the thing that I love that they mentioned was, a lot of people think, well, I'm walking into retirement, I've got to secure my investments, I've got to get really secure, I've got to get away from risk. But if you do that, you're setting yourself up for failure when it comes to keeping your buying power. And that's the main thing they're talking about here, is that your buying power erodes when you can't afford the things you need.
Yeah, here's the reality. We're very fortunate to work with lots of folks who still have pensions. And many times those pensions come from a government that's going to give them a cost of living adjustment. It used to be that everybody got that, right? Or the majority of people got that. In the 70s and 80s, you worked your whole life, you got that pension, and you didn't have to worry as much about inflation if that pension had a cost of living adjustment. Well, now pensions are disappearing in general, but if you have one from a private company, more than likely it's not going to get a cost of living adjustment. So we say all the time, your first check is your best check and your worst check. It's never going to change. You have Social Security that's not going to keep up with inflation. Just the fact that the way they figure their cost of living adjustment, which is basically the average of, I think it's late summer, it's like August, September, and October. It's the average inflation rate from 3 months from the previous year.
Yes.
Well, that's not going to always be accurate. You could have high inflation or low inflation in those time periods and not be an accurate depiction of what rates are going up, what inflation rates actually are. So the environment has changed for retirees. So you can't afford to be, to your point, Teresa, clutch on to all of your money and be as safe as possible. Do you need to do that with some of your money? Absolutely. Do you need to do it with everything you've saved for retirement? Absolutely not, because inflation is a risk that is just as damaging, or as this article points out, even more so. It is public enemy number one. Even it didn't say market volatility.
No.
Didn't say a bear market. It said inflation. So you have to have an investment strategy that prepares to grow a portion of your assets. And the only way you can do that is to invest in asset classes that will outpace it.
Yes, and the other thing to realize when it comes to inflation is this is a long-term problem now. When my grandparents were retiring, chances were they were going to have about 15, 20 years, because most people didn't retire until later, and then the life expectancies were lower. Well, for my generation, we're going to have a good 30, 35 years if we've saved well and get to retire in our 60s. So that inflation compounds over time. And if you're not doing something to keep up with that, the problem becomes bigger and bigger the deeper you get into retirement. I know there are some clients who've come to me and said, well, I want to spend more early in retirement and not have as much income later in retirement. And I have to challenge them on that. And it's because of this. Your actual spending may go down as far as what you're planning to do, but the cost of those items is going to keep growing throughout your retirement. So we can't necessarily throttle back like you'd like.
One of those advisors that was interviewed in that article said, start your planning now, meaning before you get to retirement. Couldn't agree more on that. You have to build a plan and an investment strategy to prepare for inflation before you walk into retirement, especially if you're in the retirement red zone, which is 10 years or less from your expected retirement date. We can help you do that at Gen Wealth. You can call and walk through the Ready to Retire process by calling 866-653-PLAN. It's 866-653-7526. We've got very little time left in the segment, but I want to get to this one. 2 expensive mistakes most retirees make and how to avoid them. Man, I'm going to take a class in writing headlines because, man, they get you, don't they? What expensive mistakes are we going to make? Well, the 2 are claiming Social Security too early that can permanently reduce income, or ignoring a tax strategy that can cost thousands over time. Taxes and Social Security decisions. I would agree that claiming Social Security, deciding when to do that, is one of the most important components to building your retirement income plan. I don't know that I'm in full agreement with claiming Social Security too early can be a costly mistake.
Yeah.
Yes, you are going to take a reduced benefit, and it is important that if you have any plans to continue to work, you probably do not want to claim your Social Security check prior to your full retirement age. But this is talking about, and I understand, if you claim at 62, it's a reduction of about 6% every year that you decide to take Social Security prior to your full retirement age, which is likely at this point age 67 if you're not already taking your Social Security check. And then if you delay it past 67 up until age 70, you're going to get about an 8% raise for waiting. So back to that inflation topic, right?
Yes.
I mean, you're going to get inflation-adjusted income if you wait but you can't make your decision in a vacuum.
And all future inflation adjustments are based off of your first check. So delaying in certain circumstances does make sense. But also, you've got to have a plan for how you're going to take income. And that, to me, is the biggest deterrent to delaying typically. You know, if you're going to have to take several $100,000 from your retirement assets to fill that gap, then you've lost the growth potential of those assets. So it's a conversation that really is unique to each family. It would also depend on, you know, is this a married couple where one of you has a much lower benefit than the other? Maybe you don't delay the smaller benefit just to supplement for a while and you let the other one delay. It is not as simplistic as just one or the other. Now, the taxes thing, I've seen it in action, especially if you have a lot of pre-tax money. If you don't have some sort of strategy to make sure you don't get to 73 and have to take huge distributions potentially for required distributions from that point forward, that is where I have seen it really impact people. And this affects your Medicare premiums. This affects your taxes day to day. It can be a lot if you're not prepared for it.
Yeah, the article talks about pulling money from retirement accounts without a plan that can push retirees into the higher tax brackets, increasing Medicare premiums, and reducing net income. I don't really see the pulling too much money out thing in action. I think here in the natural state and in the South, there's really the opposite that usually tends to take effect. People walk into retirement trying to make it on their guaranteed income sources, a couple of Social Security checks, maybe even a pension is involved, and their retirement savings is a just-in-case bucket, right? If I need it, I'll take from it, but I'm not going to try to tap it on a regular basis. And the opposite, that same tax bomb can take place, but it's just going to be later when RMD age arrives and you have not touched your your IRAs, and it might be twice as big as it was when you retired.
Yes, and on the flip side, we recently met with a couple who is retiring. They're retiring before age 65. So they're going to need a personal pay insurance policy to fill the gap for the next 3 years. Well, there's this issue going on with the Affordable Care Act where not all supplements are the same as they used to be, and the income gap barriers to getting those discounts is a little bit more abrupt. In their case, if we hadn't been planning ahead for it, they could have paid $3,000 a year for their premiums instead of like $300.
Yeah.
It was a drastic difference in understanding what they needed to do from a tax standpoint and to make sure their health insurance premiums were where they could afford them. So again, it's all about strategy. If you don't have someone thinking outside of just products and investments, you may be missing the mark on what you need for retirement.
Yeah, that just-in-case retirement is scary when you think about what it could do from a tax perspective. So building a holistic retirement income plan that figures Social Security claiming strategies and tax strategies into one plan for you, not the one-size-fits-all approach that you see on social media or even in a MarketWatch article. It needs to be done through the work of a financial advisor that is trying to help you and your spouse reach their goals. All right, we are out of time for today's What's Happening segment. Stay tuned. The Gen Wealth Radio Hour continues with the Get Ready for the Future show next.
You've been sold the idea that financial independence is all about some number on your account statement, or even worse, that you don't qualify because of where you started out. That's just not true. It's not about some well-kept secret of the wealthy. It's about finding the right information and knowing how to apply it. On the Get Ready for the Future show, we're answering your questions so you can start making real financial change today. The journey to true financial independence begins right here, and it starts with you.
Coming to you from the 6th floor of 3 Financial Center in West Little Rock, Arkansas. This is the Get Ready for the Future show. My name is Scott Inman, along with me, Teresa Arago, from the Conway office of Gen Wealth Financial Advisors, where our mission is to help people discover, protect, and share true financial independence. It's why we work with our clients, and it's why we do these programs to help educate you and maybe give you some action steps that you can apply to further your journey on the path to true financial independence. And we do that through the format of answering your questions. If you want to get your question in, whatever is on your mind about money, you can do it by texting or leaving a voicemail at 501-381-5228. Again, it's 501-381-5228. Maybe we'll get your question on next time, but we've got a full slate of questions here to go today. We'll start with Hillary from Little Rock. And she writes, I've heard about target date funds. Are they a good option for someone in their 50s? Yep, we've heard a lot about target date funds in the last few years, Hillary. It's a great question because they are one of the things that sound really good on paper, and they may or may not be a good fit for you, but they were really designed, Teresa, to hit the easy button inside of a retirement plan like a 401k. You basically, if you don't know what they are, that date part is the thing you should focus on. You probably have seen it inside of your 401k. The 2040 fund, the 2050 fund, the 2060 fund. And you pick in theory, you pick the year you're going to retire and you set your contributions and investments on autopilot until you hit the finish line. Sounds really easy.
Yes.
But is it?
Well, there's some things that target date funds do well, and there's some that they don't do well, and that's what it's important to understand. They can be a tool, but just like any tool, it has to be used the right way. So let's talk about what they do well first. They automatically adjust risk. So what you have is actually what's called a fund of funds. So it's one fund on your statement, but it has several funds within it. Okay, and that allows it to be diversified. So it's got a little bit of growth, a little bit of, value potentially, some bonds, some stocks. It's got a combination of investments. And over time, think of it like an airplane coming into land. That target date is your landing date, where it gets very, very conservative. But about 15 years out, it starts coming in for that landing. And so your equity exposure, your growth exposure drops while your bond exposure increases. And although that's a really great thing if you're needing an easy button, the challenge I would say that we find with that same concept is that it can get too conservative as you're walking into retirement. So again, got to use the tool the right way. They are a hands-off, easy button kind of thing, like Scott said. And it, when you're younger, using one with a really far out date certainly does make sense to just get started, so we don't maybe do what Scott did and go for that high yield fund.
That's right. Before I was a financial advisor, let's premise it by saying that.
But there are, mutual funds can be confusing in the way that they're named. It doesn't really just say, hey, this one's for growth. It'll have a bunch of other stuff in there too. So these target date funds can serve the job of helping you just pick something, getting diversified from day one, and not having to babysit it. Mm-hmm. Where I find that we need to discuss how to use this tool properly is don't set it for the actual year you're going to retire. Push it out at least 20 years because you don't want it to get to the bottom of that flight path at your retirement, because even in retirement, you're not going to have 50% bonds, which is what most of them have when you hit their landing zone. Yeah,
I think that's a great point. I love the airline analogy. So what you're really saying is they may be asking me to put my tray table in an upright position prior to me needing to do that.
Yes.
So you think about that. I mean, I love that the allocation mix is important there. It may make you too conservative. I think about what we do all the time, because here's what people don't maybe know is they do think they're on their own in their 401k, because there is the assumption that you have to have a lot of money before you can work with a financial advisor.
Yes.
And that's not really true at Gen Wealth. We believe everybody should have access to a financial advisor. And if we don't have assets that we can manage, or even if we do, we can still work with you in your 401k. You've still got to be the one to pull the trigger on that and make those decisions. So there is that disclosure for you. But the reality is we can take a look at what your company offers and we can say, hey, this might make sense for you and this might not make sense for you. And what we do sometimes, to this point of the target date funds, is we may take a retiree that has rolled over a lot of their assets into their IRA, and maybe they have 25, 30% in a 401k plan still left, and they're making contributions to it. We may have certain recommendations for the assets they have, what we would call the old money, but the new contributions we may set into a 2060 target date fund, even though they're retiring next week, because it gives them the opportunity to dollar cost average those contributions into a more volatile fund. So it's just an example of how it's a little more complicated than just setting it on cruise control.
Yes, and I think you mentioned something that really can help people understand just a good method for employer plans in general. A lot of people think volatility is not your friend. And in certain instances, in retirement, too much volatility could potentially hurt you. But when you're in your accumulation years, like I am, it's really important for you to ride some of that volatility, have some volatility, because the goal is to catch some of those dips as you're going. So you don't want to just be ultra conservative in your employer plan. As a matter of fact, you're adding to it. So you want some volatility in what you're adding to. But there are also some risks when it comes to concentration. So if every penny you've got is in that one fund, there's always a chance that you may be over concentrated in a particular area with those target date funds. Some employer plans, it's all you get to choose from. But if you have one that has more options in it, then absolutely meeting with a financial advisor to help you make sure that that is staying the right allocation for the long run certainly makes a ton of sense.
Yeah, retirement is more than just about choosing the investment strategy. You know, a target date fund doesn't know what your other income sources look like, when you're going to take Social Security, whether there's a pension involved, how much you're going to need to withdraw from that 401k, or if it becomes an IRA when you roll it over in retirement. All of those are things that a financial advisor can help you answer, create a plan for, and then see if at all a target date fund is valuable to you in your investment strategy. Great question. Our next one is from Bill, and he writes via email, my employer offers a deferred compensation plan. I'm 60. Is it worth using this close to retirement? Well, deferred comp can certainly be a great tool. It can also be a tax headache, because when you think about the people we've worked with deferred compensation plan, it usually, I mean, I love them, and it certainly allows high earners an opportunity to get more in on a pre-tax basis to their retirement savings. The problem is, when I say a tax headache, it can also come with strings attached, and I don't mean negative strings necessarily, but there are requirements most of the time on how the employer requires the employee to take it out. It may be a very specified, very short amount of time, which can help you lose or force you to lose control of the tax situation.
Yes, and I think a lot of people probably intuitively know this. When you're given a benefit, there's always a cost.
That's right.
So anytime you're getting tax deferral or you're getting to not count something as taxable income, you're going to have to, pony up at some point. And it's important that you understand how these work. So let's talk through a few of the pros. It does reduce your taxable income in your higher earning years when you participate. It can help manage your IRMA thresholds if you're at that age and you're dealing with that for Medicare. And it can bridge income between retirement and Social Security, because after age 59 and a half, you can pull out, and some of them even allow you to pull out sooner. So it depends on that. But again, it is an IOU from the employer. So there's a risk that if that employer fails in some way, then you may not get the full benefit from it that you had planned. As Scott mentioned, they have very limited flexibility to the way that you take the distributions when you're ready. It can spike your taxes later because you didn't pay taxes on it previously. So if you're taking it out later in large sums, then those taxes may end up being quite impactful to you. And then you have very limited control on how it's invested. So important to understand the two dynamics there. We're not saying it's bad, though. There are a lot of great ways to do it if it's done right.
But we were going here. It really depends on you, Bill. It doesn't depend on the fact that, hey, I'm 60 years old. Should I do it or not? What we would want to see is you come in and talk to us here at Gen Wealth, and let's walk through what your situation looks like, right? We don't know how much money you have saved. We don't know what your debt situation is. If you have compensation that is above and beyond what you need on a day-to-day basis, before you just stick it back into a deferred comp plan, let's take a look if that's the best place for it, if that's the best use of the money, because you're right, if you're 60 and you're going to retire at 65, there may be a better route over the next 5 years to put that extra cash into.
Yes, and it could be a myriad of things. And I think that's why often when people are meeting with their financial advisor, they're asking for one specific topic. And often they just get an answer to that one specific topic. But I think it's really important that your advisor be looking at other areas. As Scott mentioned, what about Social Security? What about other income resources? What about your current tax situation and your future tax situation? What are the differences you're going to see so that you can make an informed decision about how it affects everything holistically?
A lot of times it can be, if you do use that deferred comp plan, a way to delay Social Security because you've got more income coming in over that 5-year payout period than you're going to have after the 5-year payout period. So you could turn the Social Security on at the end of that and get a larger Social Security check. So there's all sorts of options there for you, Bill. But again, you need to sit down with a financial advisor and walk through that in building your retirement income plan, and that will answer your question. It is our question of the week, so we want to congratulate you for being named the question of the week. And we want to send you a free Get Ready for the Future Show tumbler. We just need you to send us an email to claim it. You can send it to show at getreadyforthefuture.com. And if you have questions about a deferred compensation plan or anything, if you're 60 and you're about to turn or you're going to retire at age 65 and you just need to know all the moving parts, getting it worked into one plan, I want to encourage you to reach out and walk through the Gen Wealth Ready to Retire process with us. That first appointment is absolutely free. We don't charge you anything to have a conversation, and we'll talk to you about our services and what we can do for you. But most of all, we're going to listen to what your goals are and see if we're a good match. You can call 866-653-PLAN. It's 866-653-7526 to set your appointment with a Gen Wealth advisor. You can also send us an email. Just send it to info@getreadyforthefuture.com. Time for another question. It is Ray from Searcy. We don't have kids, and we want to make sure our estate goes to causes we care about. What's the best way to do that? Well, this is a great opportunity for you to really make a long-lasting legacy, Ray, and it certainly sounds like you've already started to talk about that because you have causes you care about. Estate planning is essential to carrying that out, and there are some great tools that we can talk about that could be very useful for you. So I think for the first thing is you're shifting really from money to meaning, right? We do want to make sure that your retirement is taken care of. You know, I think when I read this question, I think of a specific client that I have, great guy, came to me later in life. He is still working, and the guy's over 80 years old. He wants to work, doesn't need to work. He wants to work. He likes his work. And he is never going to spend all of his money. There's even if he could, but he's not that kind of spender.
He'd have to be real intentional.
Correct. And he came to me, and I remember at one point during our conversation, he said to me, "I want to give it all away." I'm saying, "You what? You want to give it all away?" Yeah. I don't need any of this. His wife is they second marriage. They have separate finances. She's financially secure, so it's just his money. It's all he's not going to need it all. But the first thing I told him, I said, "Well, that's great. But let's give everything away you don't need." That would be a better way to do it. Yeah. We don't need to give it all away because you might need some. And he's thinking, I'm still working, I don't need any money. But he's 80 years old, health could decline. We need to build a plan, a retirement income plan, Ray, for you to make sure that you're financially independent. You and you say we, so you and your spouse. Let's carve that off. If it's $5,000 a month that you need, and by the time you factor in Social Security, you may only need to withdraw $1,000, $1,500. Let's look at long-term care. Let's look at all of the things that you need to be buffered from and make sure that your life is taken care of, right? Yeah. Then we can carve that out. Then we can take a look at what else you want to go to charity and determine the tools that would be best used. Let's talk about some of those.
Yeah, I will tell you, I'm going to own my bias here. Okay. I am a huge proponent of estate planning because I've lived the experience of dealing with an estate when there wasn't an estate plan in place. So I'm going to be honest with you guys that I have a huge bias for estate planning. I know a lot of people think, well, I don't have enough to worry about having an estate plan. I'm going to tell you, my parents had a single property up at Lake Nimrod. If you're from Arkansas, you'll know where that is most likely. If you're not from Arkansas, think the smallest town you've ever seen and then make it a little smaller. Okay, this is where that property is. A lot of people think, well, I just need a will. No. A will tells people what to do after probate is finished with your assets. So it does not protect your assets from probate, which means that there is a level of control that you have given up. The state determines what is the legal beneficiarization of your assets. I think I just made that word up, but we're going to go with it.
I understand what you mean, though.
But the reality is there are accounts that you can put beneficiaries on. You can do a beneficiary deed on your property. But the most effective way to pass things on, especially if we're talking about giving it to charities or organizations, is to use an estate plan, because the state's not going to decide that the Humane Society is the best recipient of your assets. Right. That's just not where they're going to go. So it's really important that you're careful with that. And it's really inefficient from a tax standpoint. Documents can be outdated or challenged in court if it's not really clear what you wanted. And it a lot less is going to get taken care of than you realize. It took me 2 years just to get this one piece of property allocated how my parents intended for it to be. And it cost me over $3,000 personally to take care of that for them, whereas an estate plan would have been less than that here in Arkansas.
So when you think about the estate planning tools that you can use, we've made a great case that you need to go through that process, and we can actually offer that here. We do have an estate planning specialist on our team So if you want to walk through that with us, you certainly can. But I also want to talk about some of the specific tools that are designed for charitable giving. One is really more for after you're gone, but I think there's one that you really ought to consider that can begin while you're still here and still last after you're gone, and that's donor advised funds. We've started working with those a little bit here at Gen Wealth, and it's a great opportunity for someone to begin to fund their charitable wishes before they're gone, and even see some of it actually distributed. So let's walk through a little bit about how that works. The first thing I think, and I'll hand off to you here, but the first thing you have to know is when you establish a donor advised fund and you begin to fund it, those funds are no longer yours, okay?
Yes.
So they are now in a third party's hands. So you do have to be careful, back to our original point, that you're not going to give something that you're going to need back later. That's the first thing. But then how it operates is really quite tax efficient.
Yes, and it's really great if you've had a high earning year. So we did this last year. We had a client who sold their business. They were already charitably minded. We were already going to set up an account kind of to the side that would be for charitable giving. But in their case, they had a large influx of income in a single year. So it even made more sense to do this that year. So if you have a large income year doing this, it is a charitable donation to a 501c3 charity when you make that first donation and any future donations you put into it. But you're right, Scott, you give up the control. What you do from that point forward, this third party holds the funds, and then you go in and make grant recommendations. So you get to recommend places that it can go to, but they have to be able to vet those places. So we're not giving it to Cousin John, right? We've got to give it to an actual charitable organization out of the fund. But you do get to dictate who gets it during your lifetime. And so it does allow you to be able to give efficiently and get a big tax bump in a single year to be able to lower your taxable income by a large sum if you've got those assets set aside.
There are huge contribution limits on that. For cash donations, you can actually also donate to that DAF. You can donate equities, actually.
Yes.
And that helps you avoid the capital gains tax that would become due on that. So huge tax advantages to creating that and then still seeing that money go out in your lifetime. Now, if you don't have kids, because I think this is also great for family legacy. Once you're gone, your kids can actually still operate that donor advised fund and send money to charity, but it still can be done. That's one thing. And then charitable trusts are a great opportunity to put money into. I always call a trust a third party. It's another entity that you could put money in and leave to once you're gone. And the instructions in that trust, to go back to your discussion about probate, a trust will bypass the probate process. And then that trust language, you can line up all your charities. I want to send X amount here. I want to send X amount here. I want to fund this monthly. I want to give this to a specific cause here. You get to outline that, and it can potentially be changed during your lifetime if things change in your personal situation, but you're not really funding that until after you're gone.
Correct. You establish it through your estate plan, and then you fund it when you're no longer here. I have seen it set up where also only the growth got to be donated at any given time. And so that allowed it to have some long-standing benefits for whomever. You can put a lot of rules in there. You can put few rules in there. But again, that one is not going to give you tax benefits now, but it can be beneficial for your family if you are charitably minded and you've got someone that can run it for you after you're no longer here.
Again, before we get to the final question, I want to remind you we have an in-house estate planning specialist. So if you haven't done an estate plan, whether you're charitable minded or you're just trying to get a trust set up to avoid probate, to add some protection to your real estate, reach out to us. We can get you started on that plan. 866-653-PLAN, 866-653-7526. So we've got barely 4 minutes left for Patrick here, so we'll do our best, Patrick. The question is, my wife wants to retire in 2 years, but I want to keep working until 70. Can we retire on 2 separate timelines?
It's a rare time, Scott. We get to just say yes.
Yes.
We never get to just say yes. But yes, you can.
That's right.
It requires some intentionality. Your advisor is going to have to think through what are the income needs for that gap when one of you is no longer employed. Often it really helps buy some additional time from the assets because, we don't have to start Social Security because you've got one income still coming in, or we can limit the need outside of what the other spouse is earning. So it can be really helpful for that. It can help with healthcare timing. If your spouse is younger and isn't quite eligible for Medicare, they could hop on your insurance plan for a few years and really save you some money. It's actually really common, and it's absolutely manageable with a financial advisor that knows what they're doing.
I think it's interesting, though. He says his wife's retiring in 2 years. I want to keep working until 70. I don't know how old Patrick is right now, if he's 50, because that's another 20 years. I think the only downside, I guess, is if you want to really do some things together, spend some time together. I think that's something that we walk through with our clients when there is an option to retire at the same time, or one can continue to work. But the opposite is true too. You can spend too much time together. Sometimes you want the spouse to continue to work to save the marriage, right? I mean, that's possible too. So I think there are some non-financial factors to really consider there for Patrick and his wife. But if you really want to keep working, there are huge financial advantages to that. We do it all the time. I think it just requires the planning process to determine what it looks like. So yes, to Teresa's point, we can say yes to it, but to really build more into it than that so that you can see what it looks like, I think you need to come in and build a retirement income plan to show you, okay, we lose one income from the wife in 2 years. Do we need to supplement between Patrick's current age when the wife retires and the age 70 that he wants to retire? If let's just say that's 5 years, for instance. Is his income solely going to be enough, allowing us to defer withdrawals from the assets and allow them to continue to grow? Because that would be one investment strategy that we would produce. But if we need to supplement by some withdrawals, then we have a different investment strategy that we need to create as well. And then to your point on the health care, you could possibly keep your wife on the health care. If she's not 65, that could be a great plus. Because that's really drives a lot of this. Sometimes people want to continue to work until both spouses are 65 so that they can get on Medicare. And that's a big piece to this too. So it's not really it's a definite yes.
It can be done.
It can
Not
be done.
knowing your details, it can be done.
It's the how. What does it look like for them from an income perspective? Yes,
and I think another thing that you're going to want to talk to your advisor about, just go ahead and be proactive, is what happens if you change your mind. Because it's not uncommon when spouses have different goals for when they're going to retire, that one of them will plan to work longer, and then once they see how much fun their spouse is having, they come back and they're like, hey, can we go ahead and move this timeline back a little bit? So it's really good to run those numbers too, to figure out when you can retire. That way, at least you know at this point, work is optional, and you can walk out when you're ready.
Yeah, you're talking about what-if scenarios? Is that what
we do? A few of those, yes.
Yeah, and sometimes do some more as the plans go along. But yeah, our planning software works that way. We sit in the room with our clients, and we bring it up on the computer screen, and we can actually change and move things around right there real time and see what effects it would have on your retirement portfolio. And that's at the bottom line. That's what this financial independence topic is all about. When are you going to be financially independent? You need to know that date. It doesn't mean you're going to stop working. You may be like Patrick and want to work until 70, but you might be financially independent at age 62, right? You need to know that answer. And that's what we do in the planning process for our clients every day here at Gen Wealth. They have the targeted financial independence date on paper, on purpose, so they know when they're ready to do what they want to do. And, Patrick could even scale back. He wants to keep working until 70. I mean, maybe he doesn't work full time until 70. Maybe he starts to ease into retirement slowly. There's all sorts of scenarios that can be worked out through that. You heard the bell?
Yes.
Time for final thoughts.
I think retirement and all the pieces that go into it are not just math. There's an emotional side to this too. When we're making the decision to step away from full-time work and step back into retirement, which for some is really a step forward because they're awfully busy, it's more than just numbers, but the numbers matter. So make sure that you have somebody who's guiding you through all the different pieces that you need to be prepared for so that you're not caught surprised by something and you can walk in confidently.
Some great questions today. As I look at my final thoughts, we talked about target date funds. We talked about deferred compensation plans. We talked about gifting our money, leaving it to charity. What's the most efficient way to do that? And then retiring on two separate timelines. Those are questions that everybody out there that is watching or listening to the Gen Wealth Radio Hour has on their minds. And if they have the question, that means they probably haven't done the work it takes to build a plan to get the answer. And I think my final thought is, what are you waiting on? It is
Yeah.
simple to start the process. Yeah, it requires on digging some documents up. Yeah, it requires on having a conversation with your spouse. Yeah, it requires on finding a date on your calendar to actually come in and talk to a financial advisor as opposed to going maybe playing, right? I mean, but it is so valuable to do. And I want to encourage you to start the process today. You can walk through the Gen Wealth Ready to Retire process with us by calling 866-653-PLAN. If you're watching on our video version, you see it right there, 866-653-7526, or send us an email, info@getreadyforthefuture.com. And that's all the time we have for this week's Get Ready for the Future show. Thanks so much for watching or listening, however you get the program. And join us again next week. And if you've got a question, don't forget, get it into us. 501-381-5228. Text or leave a voicemail, and we'll see you next week.
The Gen Wealth Financial Team is available to you 24/7 at info@getreadyforthefuture.com or call our offices at 866-653-PLAN. That's 866-653-7526. You should personally consult a financial advisor before making any investment, and no strategy can assure success. Securities offered through LPL Financial. Member FINRA SIPC. Investment advice offered through Independent Advisor Alliance. Independent Advisor Alliance and Gen Wealth Financial Advisors are separate entities from LPL Financial.